Imagine you and your friends decide to open a small coffee shop. You have a great idea, but no money to buy equipment, rent the space, or launch the business. So you come up with an idea. What if we split our coffee shop into small pieces and let people buy them? Those small pieces are called stocks. A stock is simply a small share of a company. When you buy one, you become a part owner of that business. For example, if the coffee shop is divided into 100 shares and you buy just one, you own 1% of that business. You are now a co-owner. So why do companies sell stocks? Simple. To raise money for growth. Instead of taking a bank loan, a company invites investors to buy shares and fund the business. In our coffee shop example, that money goes toward buying espresso machines, hiring staff, and opening new locations. The business grows. Everyone wins. Now, why would someone buy stocks? There are two main reasons. First, you can earn money when the stock price goes up. You bought a share for $10. A year later, it's worth $15. You sell it, and you've made $5. That's a 50% return on your investment. The second reason, dividends. If the company earns profit, it can share some of that profit with its shareholders, paid out regularly. It's like the coffee shop dividing its monthly profits among all its owners at the end of each month. The more shares you own, the bigger your share of the profits. In real life, all of this happens through the stock market, also called a stock exchange. Think of it as a giant online marketplace where buyers and sellers trade shares every second of every trading day. Prices change every single second, driven by supply and demand. More buyers push the price up, more sellers push it down. News, company performance, and the overall economy all play a role. Now, are there risks? Yes. Stocks are not a guaranteed return. The price can go up, or it can go down, sometimes significantly. In the worst case, a company can go bankrupt, and its shares become worth almost nothing. This is why diversification matters. Never put all your money into a single stock. Here's a real-world example. If you had bought $500 worth of Apple stock 10 years ago, today that investment would be worth over $3,000. The company grew. So did your share. On the other hand, if you had put all your money into a single struggling company, you could have lost most of it. That's why smart investors spread their money across many stocks, through index funds and ETFs. So, stocks are a share of a company, a way for businesses to raise money, and an opportunity for investors to grow their wealth. When you buy a stock, you're saying, I believe this business will succeed. That's what stocks are. Simple as that. If this video helped, like it, subscribe, and tell me in the comments, would you invest in our coffee shop? See you next time!